Good morning and welcome back, I guess, to the weekly market note with May Management. We took a week off and now we're back on for October 10th, 2025. Still in the midst of the government shutdown. Some of the news at the end of last week on China tariffs back in center stage, just when you thought maybe we get a little respite. Jokes on you, and they kind of did a little rug pull at the end of the week there with some rough performance on Friday. So if you were able to get in a little bit, good on you. Things are back today. The government shutdown is ongoing, as we mentioned. Not much changed on the recession dashboard over the last couple of weeks. Again, some of these will be static for a bit just because we don't have data. Like we missed the non-farm payrolls number. CPI this week was supposed to be out on Wednesday, the 15th. It's been postponed to the 24th. We should get PPI on Thursday, though. So that will be some inflation data coming out. Beyond that, it's kind of a lot of this stuff has been postponed with the government shutdown. But they are bringing people back to the BLS to work on that CPI report in 11 days from now, 9 days late. But recession dashboard kind of middle of the road here. Some of the data we did get, we'll go through that. We got the NY Fed's survey of consumer expectations. Inflation expectations kind of ticked up across the board. 1 year is up to nearly 3.4, 3 years up to 3.05, and 5 years up to 2.97. Those are the highest in a couple of months. And on the right, you can see we show a few different categories. And really the only places where they declined, where expectations declined, were home prices and earnings growth. The earnings growth is not great to see. Home prices kind of works both ways in that lower prices obviously benefit people who want to step in off the sidelines, but it's not great for people when your home is your biggest asset and it's declining in price. Even if you're not actively borrowing it, it's not liquid in that same way, but people do definitely track their home values, and kind of that will weigh on sentiment a little bit. But I think, for the time being, we've clearly shown that there is pent up buyer demand on the mortgage and the housing side of things. So if you do get some moderation, again, remember, these are coming off of all-time highs. So it's not as if people are underwater unless they, it's more kind of just off of moderating.
The relative price
exactly.
change. Yeah.
But I did see an interesting chart that we are about to have, I think by the end of the year, more 6% mortgages than 3% mortgages in the housing market. So that shift where you either got in before the Fed rate hikes in 2022, or people have now been coming in for a couple of years with elevated rates. And so we're about to hit an inflection point where there are fewer 3% mortgages than 6%, which is interesting. Continuing with that SCE, credit and finances, they poll people about their credit availability or the availability of credit from a year prior to present, and then their expectations for year 4, and they do the same for financial situation. And I think people are kind of expecting credit availability is maybe going to get a little bit easier over the coming year. And again, these are very much on the margin, no big seed changes, but we are a little admittedly strapped for data this week and last week. So this is what we're getting. And the financial situations, maybe a little bit worse in a year. I think that's kind of people that are seeing or feeling the inflation, their expectations. But it is good to know that, with the Fed kind of easing, that credit availability is improving. It should help loosen things up. But I think, it's again, kind of reflective of where people think earnings growth will slow and inflation will increase. That's going to weigh on your financial situation. That's kind of plain and simple. So no big surprises there. On the consumer credit side of things, we got a $0.4 billion gain in August. That was well below forecast for a $13 billion increase. Non-revolving credit was up 6.3, while revolving credit fell 6. That's the biggest decline since March. And again, non-revolving is mortgages. So this is clearly, I think when you see that driving it, people, and this is the last 2 months, July and August, where mortgage rates have kind of been trending lower coming into September's rate cut, expecting another rate cut here in October, that people are clearly stepping in and picking up more and, initiating mortgages, which is evidenced by the non-revolving credit increasing. But on a year-over-year basis, things are, kind of slowing. Total consumer credit is up just 0.2%. Non-revolving is down to 1.1. And revolving credit, that's like credit cards, kind of stuff that turns over more quickly, is down 2.5% year over year. That's the most negative since April of 2021.
What do you think's driving that come down in the year over year?
I think there's some weird stuff with the comps. You can see like there is some
spikes.
Yeah, some spikes in July and August. especially as we get into the end of the year. But also, I think people are maybe pulling in their horns a little bit on the revolving credit, on the credit cards, and there's been talk about kind of this slowdown in consumer spending. I don't think that's necessarily a huge concern, but it is also noting in that it's maybe a potential. But I think for the time being, looking at where spending and GDP forecasts are tracking for Q3,
Yeah.
things are pretty solid.
Yeah, that's kind of my impression. Spending remains pretty solid here.
And they do, JP Morgan, which one of the benefits to their like consumer facing credit side of things is they get weekly spending data off of all their credit cards that they can track. And they put reports out on this. And for the time being, it seems like it's holding up. Maybe it is slowing a bit, I think. But again, it's not like it's falling off a cliff here. So I think this is just a result of, again, we're still, we're kind of dealing with these pandemic effects. And especially with the pull forward in demand earlier this year, where you saw in March and April, demand was kind of pulled forward as people were trying to deal with the tariff and the potential prices. So yeah, nothing kind of hugely concerning there. On the mix shift, so you're seeing again here, these total levels of consumer credit are basically at or near all-time highs for total and non-revolving. And again, non-revolving is the bulk of that because it is mortgages, and those are just on a dollar basis far larger than a credit card balance. Credit card looks like it's maybe revolving, maybe trying to start hook back up, but we're seeing kind of a reversal in this shift where for a long time, it was non-revolving was 75-80% of it, call it. I think I can read that from here. Non-revolving was, obviously the balance of that one minus. And then you saw this kind of that blow out a little bit, and now it's started to come back, and then it's kind of starting to blow out again, where you're seeing, I think this again is people are stepping in off the sidelines for mortgages, really. And that's what's taking share from the consumer, the revolving side of things. So it's definitely a shift that's occurring as people are being incentivized to go back into the housing industry or housing market by lower rates. On the consumer sentiment side of things, we got the University of Michigan October preliminary reading that ticked down to 55, the third straight decline. It was above forecasts. We get a revision here at the end of the month. Expectations continued down to 51.2. That's their fourth down month in a row. And current economic conditions bucked the trend and kind of inched up to 61. 1 year inflation expectations came down to 4.6 from 4.7, but that's still pretty elevated. And then 5 year expectations were unchanged at 3.7. So again, here, we've talked about this, but this thing feels kind of broken.
Yeah.
Lower than it should be. So something, kind of within the methodology or whatnot is kind of keeping this lower than it should be, because it doesn't seem like people are quite that.
It's like the perfect storm for why it's lower. The combination of inflation being a huge driver of it, the phone surveys are moving from phone to internet surveys, plus probably some harder things to track, or harder things to measure on sentiment. It feels like you can look at it directionally, but on an absolute scale, it's hard to kind of take anything.
I think you'd almost have to just look at it post-COVID.
Yep.
And then you take the relative levels there, and even then we're low.
Yep.
But if you just looked at that, you wouldn't see this kind of structurally higher pre-pandemic kind of regime that we've kind of switched out of. We also got used car prices. So the Manheim used car price index was down 0.2% month over month. It's the second down month in the last 3. On the right, you can see the index. The dark blue line is the index itself. It's at 207, but it's 20% off of the highs back in January of 2022. And on easier comps, it got down to below 200, so it's kind of grinding sideways. But on easier comps, it's up 2% year over year. Again, we'll get the BLS figures on the 24th when they release them in that CPI report. But Manheim came out with theirs, and that's really kind of the bulk of the data. I mean, as we said, it's a light data week. This week is expected to be the same, but kind of, high level. The survey of consumer expectations show that inflation forecasts ticked up a little bit. Price expectations are up for medical care, food, gas, rent, while kind of credit availability and financial situations are probably going to be roughly unchanged, which is a good thing. You don't want to see a material deterioration in expectations around that. Consumer credit posted to kind of a meager gain at 0.4 billion, but again, non-revolving is carrying the weight there as people are maybe moving back into the housing market. The preliminary reading for Michigan consumer sentiment ticked lower. Inflation expectations moderated a bit, and then Manheim used car prices down 0.2%, up 2% year over year. There's a lot of twos in that. Minus 0.2 month over month, up 2.0 year over year, and down 20% from the peak. And then, we had CPI has now been pushed out to the 24th. PPI we should get on Thursday. Hopefully we'll get retail sales and industrial production as well. And then we get some of the regional New York, I think New York and Philly Fed manufacturing indices. But that's kind of the long and the short of it. This week's a little bit shorter given the kind of dearth of data.
Yeah, we'll see what the tariff announcements hold, if there's any additional kind of pressure from the White House. I would say like over the weekend, this is kind of a trend that's persisted since earlier this year, kind of since Trump entered office. You have this initial very strong headline. I think it was after market close on Friday. It was this 100% additional tariff on China, and that's kind of being pulled back, maybe negotiated, and it's this kind of trend that I expect to continue, where you get these big, kind of large headlines that make an impact, and then from there it's negotiations. Lead with a punch and then dial things back. So I don't know. It's something to keep an eye on. I think it's very easy to react to those big headlines, but realizing that, hey, like most of the time there's negotiations and it's pulled back to something a little more reasonable.
Yeah, less extreme. And I think, from what we've seen is the couple of pieces I've read on it, most people expect, or at least they hope, that Trump and Xi will look and realize, hey, we're basically the two biggest economies on the planet. If we go into this kind of deleterious, painful trade war, that will drag the rest of the world with us. And they don't want to see that. And I think that's in nobody's interest, is to create, we are so intertwined, no matter how much you like or dislike the dynamic. The reality is we're very, very intertwined. And so when that sort of thing kind of comes out, the headlines definitely are a knee-jerk reaction, usually to the negative side. And then it's also, conversely, if you get a positive headline, things will absolutely pop on that. But I think it's generally the reality settles in the middle, as we've seen time and time again, and kind of hoping that, the powers that be realize, like, hey, we shouldn't take this car off the cliff without leaving skid marks.
I mean, it's what you saw in April to some extent. The Liberation Day, and then the kind of pause after that, and the subsequent, it was like 10% intraday move in equities. So I don't know, something to keep an eye on, not to overreact to the day-to-day or minute-to-minute headlines.
I think that about sums it up. So thank you again for your time, and we'll talk to you next week.
All right, thank you.
Take care.